the cyclically adjusted PE, otherwise known as CAPE. We won't get into the weeds of all the details of what it is, but basically what that is taking a common valuation metric of the stocks of the stock market, the PE ratio, price to earnings, and adjusting that over 10 years for the general idea that earnings can be volatile. And so if you smooth them out over 10 years, you'll get a better output. The higher that number is, tends to mean that the market's more expensive. Going into this year, the CAPE was sitting at about 40 on the S&P 500. For context, and this has been going around a lot in finance circles, the 10-year returns of major markets around the world has never been above average. So you've effectively never had an above average decade for a stock market when the CAPE is at 40 at the beginning of the year, and the average return has actually been negative. So should market participants, and not short-term, but long-term, be worried when stocks are this expensive coming into the year, according to at least this metric?
I mean, the short answer is yes, right? Like, I think I'll caveat by saying it is important. And we tell this to clients, obviously, because when people come to us with this one statistic that they're anchoring to, there is really no one statistic that will determine what markets are going to do. If there was, it'd be a lot easier for all of us to make money in markets. That said, when you have something that has as much historical precedent as the one you just mentioned does, it is worth paying attention to. And I think it's the same drum that we beat, and we beat it because it has real meaning, not just because it's easy for us to say, but like, you need to be risk adjusted and diversified in your portfolio holdings. Like, I take that stat. If you dumb it down, should I stay invested in only US large cap stocks for the next 10 years? No, because the last 15 years that's been the best place to be. And that's not going to be the best place to be at some point. Simple as that, right? Like, I'm a huge believer of that. So that's my quick kind of gut answer to your question, because it's a really good stat to consider.
So I agree, and not that I disagree, but I agree, but also have a different perspective that if we've had such great markets, and that's why prices are expensive, that means we probably haven't had just a really bad market year or two for any number of reasons in a long time. So let's just say CAPE's at 40, we're talking 10-year returns here. We might be rocking and rolling, making money in the stock market for the next 5 years. So it's not like you got to get out now thing, because we're talking about a long time from now. So you have a good couple of years. And just because it's now been 3, 5, 7, 10 years since you had a really bad market for any number of reasons, I don't think you can make that change now. And that bad time that could come in several years could take your 10-year total return to a subpar number. So I think it might not be specifically prices are expensive now, therefore they must go down because they're expensive. We're just going to have some other event potentially that throws us for a loop, that pushes the markets down, that leads it to be a subpar 10 years. Again, that might happen tomorrow, and it might not, and that might happen in the 9th of 10 years. So it's just so hard to time. And back to Pat, what Pat said, you got to be diversified. You can't just own large cap stocks, because other things hopefully will do well during that time.
To back that up, I mean, if you use this indicator as your metric and got out right away, you would have gotten out years ago and you would have missed a lot of the rallies. So it's not like run for the hills. But I think, again, just reiterating back to Pat's point, the so-called lost decade in the S&P 500, the last time we were at levels like higher than this actually on the CAPE, wasn't a lost decade for international stocks, emerging markets, small caps, bonds, dividend stocks. There are still places to make money if the S&P 500 actually lags what it's done recently. And to Aaron's point, it may not lag for some time. Who knows? This is just one metric.